Hello students, this is Professor Vincent Osaya. Welcome to my class. This is part 1 of chapter 14 presentation, long-term liabilities. As you know, the objective of the whole course is in threefold. Number one, we are to understand the accounting principles of the relevant topic and how to apply the principles. Then number two, based on our understanding of the accounting principles and the applications, we are then to prepare the underlying financial statements and their disclosures in accordance with GAAP. Then ultimately, we are now able to analyze and interpret the financial statements. In other words, being able to tell exactly what the numbers mean. Now, having said that, the underlying financial statement here in chapter 14 is the balance sheet. As you know, the balance sheet has three components: assets, liability, stockholders, equity. And we said that the balance sheet is a financial statement that talks about the financial condition of a company at a point in time. Now, in chapter 13, our main focus was current liabilities and contingencies. In chapter 14, we are shifting gear and we are now talking about long-term liabilities. So that is the main focus of chapter 14. So now let's take a look at the specific objectives of chapter 14. Number one, we are to be able to describe the formal procedures associated with issuing long-term debt. We are going to talk about different types of bond issues. We are going to talk about accounting valuation for bonds at the date of issuance, how to apply the methods of bond discount and premium amortization. We are also going to talk about the extinguishment of debt. We are going to talk about accounting for long-term notes payable, fair value option, and off-balance sheet financing arrangements. And then ultimately, we are going to talk about how to present and analyze our long-term debt. So those are the specific objectives of this chapter. So let's take a look at the first objective. Before we do that, let's take a look at the fact that this chapter is breaking down into 4 categories. Number one, we are going to talk about bond payable. Number two, we are going to talk about valuation of bond payable, long-term notes payable, and reporting and analyzing liabilities. Now, moving along, let's take a look at bond payable. Here we said that long-term debt, bond payable is one example of long-term debt. We said generally long-term debt consists of probable future sacrifices of economic benefits arising from present obligations that are not payable within a year or the operating cycle of the company, whichever is longer. We talked about this extensively in chapter 13 by way of defining what current liabilities or what current debt are. Essentially, pretty much the same definition here. The only difference is here these are obligations that are not payable within a year or the operating cycle of the company, whichever is longer. Now, let's take a look at the examples of long-term debt that we have here. 5, bonds payable, long-term notes payable, mortgage payable. Number 4, pension liabilities, lease liabilities. The last two are going to be discussed extensively in 2 subsequent chapters before the end of this semester. But our main focus here are bonds payable, long-term notes payable, and mortgages payable. Of the 3, bonds payable is going to be discussed more extensively in this chapter. So, having said that, let's take a look at the basic characteristics or issues regarding a bond. So, issuing bond. We said that bond is a bond contract is known as a debt indenture. In other words, the company that is issuing bond has a contractual relationship with the creditor. That is the individual or the bondholder extending credit to the company. Now, let's back up for a minute. Now let's take a look at one important issue here, and that is the difference between debt versus equity. Debt versus equity. See, every financial security like common stock, bonds, options, so on and so forth, is either debt or equity. So if you take a look at the balance sheet, you have the balance sheet assets, liabilities, stockholders' equity. So if a company has $100 million in total assets, the $100 million in total assets comes from liabilities and equity. So if liability is 70 million, of course, stockholders' equity will be 30 million. Now, when a company issues financial securities like common stock and sell common stock to the public, the investors are buying into equity or ownership of the company. So we said that common stock is an example of an equity financial security. Now, instead of issuing or selling common stock to the general public or to the investors, sometimes the company can decide to issue bond. Now, bond is also a financial security or a certificate that the company will issue to raise funds. However, bond is a debt security because the company is indebted to the bondholder or to the investor. So if a company issue a bond, bond is simply a certificate indicating that the company issuing the bond or selling the bond is indebted to the bondholder or to the investor that decided to buy the bond. So come back, we said that bond contract are known as bond indenture. Now, something very important here. I want you to know that don't confuse bond indenture, which is a contract, with debenture bond. We are going to talk about that in a minute. Debenture bond is one of several types of bond. Bond indenture is a written contract between the company issuing the bond and the investor buying the bond. So moving along, we said that still talking about issuing bond, it represents a promise to pay. So the company that is issuing the bond or selling the bond promise to pay. Number one, a sum of money designated at a designated maturity date plus periodic interest at a specified rate on the maturity amount. That's the face value. What does that mean? So a company issued, why would a company issue bond or common stock like we indicated earlier to raise resources or raise money for their operation, okay? So when a company issues bond of $10 million and an investor buys the bond, that investor is a creditor. The company is a debtor. So the company is indebted to the creditor. And the company issuing the bond is promising the creditor two things. Number one, at maturity, be it 5 or 10 years from now, we will pay you back your principal of $10,000. Every year or every 6 months, however the case might be, we will pay you interest. So the company issuing the bond is promising the creditor these two things. So moving along, we say it's a paper certificate, typically a 1,000 face value. So just like we have currency, we have $100 B, $50 B, $20 denomination, so on and so forth. For bonds, where it comes in different denominations, 1,000, 5,000, 10,000. The most common is 1,000. Interest is usually paid semi-annually. Sometimes it could be annually. Used when the amount of capital needed is too large for one lender to supply. So if the company needs $500 million and no one bank or no one individual is willing to part with $500 million, the company can decide to issue bond and have a lot of investors buy their bond in order for them to raise funds. Moving along, let's take a look at objective 2. Here are different types and rating of bonds. Number one, we have a secure and unsecured bonds. Secured meaning the bond is issued and the bond is backed up with a collateral. Unsecured, that means it's not secured, okay? It is issued based on the credit worthiness of the company. Then we have term bond, meaning the principal is due at a particular date, 5 years or 15 years, however the case might be. Serial bond, a portion of the principal is due periodically. And callable bonds, those are bonds that have the feature whereby the bond issuer or the company issued the bond is able to call them back and buy them back. And then we have a convertible bonds. Those are bonds that can be converted to another type of financial security. Commodity backed, those are bonds that are backed with commodity. They are usually redeemable a measure of using a commodity like coal. Then you have a deep discount bonds. Those are example of those are zero interest bond. You know, for example, series United States series EE. You buy a bond, the face value is $100. You actually pay $50. At maturity, the value becomes $100. We're going to talk more about that eventually. Then we have registered and bearer. Registered meaning the bond is registered to a particular individual's name, and bearer meaning no one is actually the bearer actually has the right to claim the bond. Income and revenue bonds, those bonds usually pay no interest except when the company is profitable. Okay, moving along, let's take a look at types and ratings of bond. Here's an example of corporate bond listing, as you can see in Wall Street Journal or your local newspaper, the business section of your local newspaper. Here we have a Walmart as the issuer of this bond. The coupon, this column has two titles. Coupon is the interest rate that is specified on the bond. In this case, it's 3.2, and the maturity is the maturity date 10/25/2020. The price here is 102. That is 1 or 2% of the face value. We're going to talk more about that eventually. And the 96 high-low. Here they talk about. I'm sorry. Price high-low. 102 is the highest, and 96 is the lowest in terms of the selling price of this bond thus far. Then the yield, that is the effective of the market interest rate. We are going to talk about this extensively. Here, the highest is 4.8 versus 2.9. So that is basically it. You have the company's name, the price as a percentage of par. We are going to talk more about this eventually. Now, moving along, let's take a look at the valuation of bonds payable. Issuance and marketing of bonds to the public usually takes weeks or months. The issue company has to make an arrangement with underwriters. Underwriters are the company that serve between the issuing company and the investors. So the underwriters are responsible for doing all the legal paperwork, so on and so forth. An approval has to be obtained from SEC, that is the Security and Exchange Commission, which we talked about in Chapter 13. And we have to have a bond certificate printed. Those are real certificate that looks like your diploma. The bond certificate simply is evidence that the company is obligated to the bondholder or to the creditor. So, valuation of bond payable. I think this would be a good point to wrap up part 1 of the presentation, and we'll take it from here later.